one thing is clear: when money is tight, and by tight I mean really tight, high yield bond spreads vis-a-vis treasuries explode. In other words, you would see a huge increase in spreads. This hasn't happened yet. The spreads have actually been very steady at a low level compared to previous financial crises when the money became tight. Secondly, when money is really tight, you have very little speculation. Hasn't happened yet. There's a flurry of speculative activity in anything that seems to be moving. The money flows in, the money flows out. There's plenty of liquidity. Now, if you tell me that the worker in America is suffering from less liquidity because he has real wages that no longer cover his expenses, and that he has to wait for his salary to arrive at the end of the month in order for him to pay the bills, that is, I would agree with. But in the financial market, I don't see any tightening of liquidity.
On this episode of the What the Finance podcast, I have the pleasure of welcoming back Marc Faber, who's editor and publisher of the Gloom, Boom, and Doom report. So, Marc, thanks so much for coming back on the podcast today.
Thank you very much for having me on your program.
No problem.
It's a great honor.
Oh, thank you. And you're one of our most popular guests, so we're very happy to have you back.
Well, as a contrarian investor, popularity is undesirable.
It's not a good thing there. Might have to change some things. But in our last conversation, it was sort of about 6 months ago, so in April, 7 months ago now, and we were speaking about the risk of there being quite a long bear market in sort of many of the markets that have performed quite well, so the US and other developed markets, and you were saying they were quite overvalued. So are you still sort of seeing that perspective? Do you still think they're quite overvalued and there could be this long bear market?
Well, the world is a very big place, and as you know, we have different economic developments in different sectors and in different regions of the world. So to give you a summary, what I see is still a huge overvaluation in American high-tech stocks, in the FANG and FANG-related stocks of Facebook, Amazon, Netflix, Apple, Microsoft, and so forth, and semiconductors, NVIDIA. And then I see the low valuations relative to the high valuations in, say, sectors like energy, oil in particular, and in mining stocks. And then in the world, emerging markets now are at the lowest level they have ever been compared to the US. I mean, they were cheaper compared to the US in the 70s, but this was an extraordinary time. But other than that, they are now very, very low. And say, if we talk about cheap stocks, I was looking the other day at the Hong Kong land. There's a large property owner in Hong Kong, and throughout Asia, they own properties and develop properties. And it's a reasonably well-managed company and not too much leverage. But it sells, the price is now 0.22% of book value. Now, I'm not saying that Hong Kong property prices will go up. I think they can go down another 30% maybe, or even more. But I doubt they'll go down 80%. So you have a fairly large cushion against disaster. And my view would be the patient investor who buys stocks like that, and also in China, if you travel around the world, everybody's negative about China. Have they sold out all their shares in China? I doubt. They still have stocks. But at the present time, there's practically no buying interest in China. And then Latin America is also a continent where valuations are low and where people have probably not much investment. But if you think about World War III, and I have friends who are very well informed, their principal concern is World War III. It's not my concern because of my age and also because of the location where I live. But basically it could happen. And in that case, you should have some investments in Latin America, because Latin America would unlikely be a war theater. The war theater would likely be, say, in Eastern Europe, Middle East, and maybe on the North and South China coast, something like that. But it would unlikely be in Brazil and Argentina. So for that reason, I think some people or investors should have some money in Latin America.
Okay, it's really interesting. So do you think they, and I've heard this opinion recently, and I thought it was quite interesting, that if we look at the past 40 years, duration was rewarded. So say, longer bonds or growth stocks that you assume are going to grow into the future. But do you think maybe we've seen a shift where it's going to now be the shorter duration, so short-term bonds, all those high cash flow companies that are going to be rewarded?
Well, I mean, long-term bonds were good investments between 1981 and 2020, but have been a disaster in the last 3 years. And in fact, as a contrarian, I'd say long-term bonds having collapsed, and it's never happened before in history. But if you think about it, why did it happen? It happened because of central bankers. Central bankers first pushed interest rates down to unprecedented low levels in the history of mankind. And then interest rates, these low interest rates fueled a wave of speculation and an inflationary environment combined with the fiscal deficits that we had. And so inflation exploded on the upside and interest rates then rose, whereby in the 70s, when interest rates, when inflation was at the present state, interest rates on the 10 years treasury bonds were much higher than 5%. Already in 1974, on the 10 years treasury, in the US, rates went to over 12% on the 10 years. And then when inflation accelerated thereafter into 1980, 81, interest rates went over 15%. So I think we're in the early stages of the interest rate increase, but that is a long-term view. Short-term, I think the interest rates may come down somewhat in the next 6 months, because, and this has been my view for now more than 6 months, my view is the US and Europe are already in recession. If the figures, if the statistics were properly measured, but the governments are very good at lying to the public all the time. And so they tell the public their GDP is growing, when in fact, the real incomes are your salary increase compared to the cost of living increases. That everywhere, for the middle class, for the ordinary people, everywhere, the cost of living are going up more than the salaries. In other words, their standards of living are going down. The standards of living of government officials, they go up, and of the 1% or 0.1% of the wealthy people.
Okay, so you're saying that we're already in a recession. I guess
correct.
Maybe
yes.
Yep. What are your thoughts on unemployment? Because it's actually remained quite low. Do you think that's being measured correctly, or it's the wrong measure to look at?
It's probably measured halfway correctly, but not 100%. And we have to see one thing: employment could stay low because people are disabled. You know, if you have an insurance, if you have social policies that reward disabled people, instead of becoming unemployed, someone may report himself as disabled. Like I, as an economist, I may become disabled when I look at the quality of our governments. I may become insane.
Definitely seems to have that impact. So what you're saying is there's more, maybe even though unemployment's remaining quite low, it's just the pool that they're measuring. So there might be a lot of people outside the pool of the unemployed that they're not measuring, that, as you said, could have disabilities.
Yes, exactly. Yep. Yes, that is what I mean. And I'm convinced that in most countries of the West, unemployment is very low because some people find it more advantageous not to work. And also, as I said, by reporting as disabled, you're not being in the army of unemployed people. And the second reason why unemployment is low is that people simply don't want to work. You know, in France, they work 35 hours a week. I think, I mean, of course, people look at me as a right-wing pig. But in my view, people should work as long as they like, and not as long as the union tells them they can work, and so forth. And if a teacher wants to work 50 hours a week or 80 hours a week, it should be able to do that. Like I work much more than 50 hours a week because I work Saturdays and Sundays, and every day of the year. I don't take holidays at the present time because traveling is now so unpleasant compared to what it was before 9/11 and before COVID and so forth.
Yep. Okay. That makes a lot of sense. So then, from your perspective, the US is in a recession. When do you think it will come through the data, or you don't think that will happen? They'll continue to maybe push forward these different data points that are showing that the economy is growing.
I think it will, in time, it will become obvious, you know, that the living conditions are deteriorating, and people will then want to have a change, but maybe the government will not. You know, the problem is, if I were a politician and I wanted to get elected and I wanted to do something for my country, I would have to go to the people and tell them, look, we're spending too much. We have to cut government spending, and we have to increase taxation. How many votes would I get? 0. How do you go and tell the veteran of the Army and Navy that the pensions will be cut? How do you tell the firefighters, and how do you tell the policemen that the pensions will be cut, and at the same time the taxes go up? So the solution is, we have inflation. We can tell the people the inflation is because of Putin and because of Hamas and because of whatnot, but we don't tell them that inflation is a tax that arises because we don't collect enough taxes in the first place, and because we spend too much. So this is a convenient lie.
Yeah, and it links quite well to my next question, which is actually, you released some work recently, which talks about your opinion on what the Fed is doing. So if I quote it, and I think I heard you talk about this in another interview, which I really enjoyed. So the quote is, "In my opinion, the Fed is actually misleading the public by pretending that it's tightening monetary policy, when in reality it is pursuing policies which are likely to increase inflationary pressures and to depress real wages," which seems to be like what we're talking about now. So in your opinion, how is the Fed doing this? Because I guess the traditional people would say they're increasing interest rates, they're doing quantitative tightening. They are tightening.
Yes, this is the conventional view. But I can tell you, instead of listening to the words of Fed officials, I think by looking at the market action, you can get some clues whether money is tight or not. One thing is clear: when money is tight, and by tight I mean really tight, high yield bond spreads vis-a-vis treasuries explode. In other words, you would see a huge increase in spreads. This hasn't happened yet. The spreads have actually been very steady at a low level compared to previous financial crises when the money became tight. Secondly, when money is really tight, you have very little speculation. Hasn't happened yet. There's a flurry of speculative activity in anything that seems to be moving. The money flows in, the money flows out. There's plenty of liquidity. Now, if you tell me that the worker in America is suffering from less liquidity because he has real wages that no longer cover his expenses, and that he has to wait for his salary to arrive at the end of the month in order for him to pay the bills, that is, I would agree with. But in the financial market, I don't see any tightening of liquidity. Also, the VIX index, the volatility index for shares, is low. Actually, last week when the market rallied, the VIX index fell by 37%. This is a sign that liquidity isn't tight. Now, I'm not an expert on how to measure precisely where the money is allocated, but just looking at these indicators would suggest to me that liquidity isn't tight enough. Also, if you think about, say, Turkey, the rate of inflation in Turkey, say 100%. Deposit rates are also around 100%. So is money tight in Turkey or not? Interest rates are high, but this is something that Milton Friedman already explained very carefully. The absolute level of interest rate does not tell you whether money is tight or not. We could have high interest rates, but no tight money. And in the 70s, because I started to work precisely in January 1970, so I experienced the end of the 1970 bear market, the recovery into January 73, and then the bear market 73, 74, and the recovery and the gold bull market, the commodities bull market, and the inflation acceleration throughout the 70s. Now, with the inflation, it was like this. In 74, the 10-year treasury yield was already over 12%. But then inflation cooled down in in the second half of 74, 75, and until the summer of 76. And after the summer of 76, inflation accelerated again. So was money tight? It became tight in the recession 73, 74, but only for a brief period of time. The 70s were characterized by interest rates being negative in real terms. In other words, money never was really tight until Volcker squeezed the system in 1979, 1980, and he pushed interest rates on the short end to over 20%. So then money became tight, and we had a period of disinflation that followed. But in my view, looking at the market action, money isn't tight at the present time.
If I push back on that, it seems I agree with you in terms of maybe assets and as you said, there's lots of speculation. But then if you look at the real economy, it does seem that money's quite tight there. So lots of people, there's not as much debt being issued and other factors. So do you think there's a disconnect maybe between those two markets?
Yes, this is the tragedy of ill-conceived monetary policies by the Fed members. And you have to see, the Fed members are not working for the poor man. The Fed members are all marionettes, puppets of people with money. And they favor policies where they can say, well, we're tightening monetary conditions, we fight inflation. No, they don't fight inflation. They like inflation. Every government, when they are faced with fiscal deficits and with the choice to go to the people and say, especially in front of an election, ahead of an election, how do you think Biden would be perceived if he went to the American people and said, we have to increase your taxation? The rich people never paid taxes in history. They paid a little bit, but not much. The taxes usually fall on the upper middle class and the lower middle class and the workers, because they are salary recipients. There you have a precise accounting of how much someone earns. The rest is difficult to measure.
Okay, makes sense. So if we look at the short term, you were saying that maybe we already are in a recession. We could potentially see disinflation, but then I guess from your perspective, the longer term trend is going to be higher inflation for longer.
The point is this: the price level, say, goes up. Let's say we estimate here, we're not sure, but say the price level today is up 30% vis-a-vis 2019. And then from this level, the prices drop by 3% or 5%. We're still up more than 25% vis-a-vis 2018, 2019. But then the central banks will say, well, now we have deflation. We have to ease. They're waiting for an opportunity.
Okay, that makes sense. So if we go back to, and this is still on bonds, if you go back to, I guess, 1940s, 50s, after the war, there were these bonds and they were drastically devalued due to higher interest rates, higher inflation, etc. Which was sort of like a distribution away from sort of wealthy individuals to the working people. Do you see something like that happening in the future, or do you think it's potentially going to be the opposite?
Well, in the back of my mind, I think we had colossal asset inflation, 1981-82 to say 2020. Irregular. Some markets peaked out in 2015. Japan already in 1989 and so forth. But by and large, we were in heaven for asset prices. You look at real estate. I thought 2007 would be a major high for US real estate. No, it went down for 2 years, and then it went and made new highs, remarkably. But now the situation, some people call it the Pax Volckeriana, because Volcker, he brought about monetary policies that had a disinflationary impact. He broke the back of inflation. Inflation, in my opinion, would have come down regardless, but he implemented monetary measures that accelerated the shock to the system. We also had a colossal recession in 81-82. Unemployment jumped to over 12% at the time in America. Now, this period of glamour for stocks, bonds, real estate, collectibles, art, anything is over. Why? Because interest rates are going up gradually. Say, in my case, I benefit. This is also a reason why the tightening doesn't work so well at the present time. I had cash because in my business, I need a lot of cash to run the investment business. But I also had cash because I wasn't very bullish about the asset markets in the last 12 months. So suddenly now I can get on a yearly deposit or 9 months deposit or 6 months deposit. I can get 5.5% yield. 2 years ago, I got 0.5%. So my financial position, my cash flow position has improved. It may go down because I own dividend stocks, and if the corporate earnings collapse, then the dividends will be cut. But I'm just saying some people have actually benefited from the increase in interest rates, whereas others that have large credit card debts, student debts, variable mortgage debts, they are all suffering, and they will continue to suffer. So your observation is absolutely correct. The monetary policies by the central bankers, it shows how ignorant the central bankers really are. The policies that they implemented have hurt the poor people and benefit people that have assets like myself. It's crazy.
So what should they do? Should they tighten?
They should all resign. That is the first thing. We need new people at central banks that are people that have been running a business, that have some business experience, that know how tough it is to run a business, to pay the employees, to cope with all the government interventions and the regulations and new laws all the time, and and then at the end to show a profit and not to go bankrupt, and how to obtain subventions by the government, and then I mean, it's an endless mess. But the people that we have at the Fed are people, mostly, they have never worked a day in their lives in the private sector. They all went to university. In the university, they were brainwashed by communist and socialist teachers. Most teachers are socialist communists. The teachers, the university professors never worked in a job. We are in a dictatorship of the bureaucrats, the worst type of system you can have, because in a kingdom, in a feudal system, you can get rid of the king by killing him, by eliminating him and starting a new dynasty. But in a bureaucracy, nobody's responsible. They all say it's the other department. Soon as something goes wrong, I just followed my orders. That's the bureaucracy. When you go through airport, if you complain, they say, I'll just follow my orders. The other day, I mean, not the other day, about 2 years ago, I went through an airport in America, and I ordered a beer in a bar at the airport. You know what she asked me? Can I see your ID card? I said, for what do you need an ID card? Well, we have to check your age. I said to her, look, if I look as younger than 21, unbelievable. I follow my orders. How can you run a business with follow your orders? Where's the creativity? People don't want to be responsible. They want to follow orders.
So say if you were the Fed chair, if they got some sense and they elected you in, what changes would you make?
Well, the change would be very unpleasant, that I guarantee you, because I would say to the government, look, I'm not financing your deficits anymore. Either you bring your fiscal house in order, or you'll have sky-high interest rates. And the governments now suffer from rising rates. Keep this in mind. So the governments will try to lower rates, which will be inflationary.
Yeah, I can't.
But I mean, I want to give you, before I need to go, but I want to give you one or two ideas. I think that if I look at the last 2 years, end of 21, Turkish stocks were very cheap. And then I wrote 2 reports about Turkey. And then, of course, the Turkish readers and so forth, they wrote to me that everything is bad in Turkey and that the currency will go down and so forth and so on. But in 2022, the Turkish market went up by 100%. And then at the end of 2022, I looked at Iraq as a stock market. It was very depressed. This year, the Iraqi fund is up something like 90%. So there are always opportunities. I think Hong Kong properties are very cheap. Property stocks are very cheap. Chinese stocks are inexpensive. Pakistan is written off, essentially, but the stock market is very low. And Pakistan is not a country that is hopeless, not at all. They have an educated class, and I think from this low point, the market could actually do quite well. So there's a Pakistan ETF that I would essentially buy. And then in Latin America, Brazil is inexpensive, and Colombia, very cheap.
Okay. And then so I guess a lot of people were talking about currency exposure and risk, and then you mentioned there that there's ETF. So if someone wanted to get into some of these countries which have less liquidity, would you say the best way is through an ETF? And then
for individual investors. Before, I used to go to these countries and open a brokerage account. But now, due to my age, I don't do it anymore because I'm in the last 10% of my lifetime. So I have to start thinking about my family and so forth. But if I were young, I would go and open a brokerage account. I had brokerage accounts in Pakistan before, and also in Colombia, and in Argentina, Brazil, and so forth.
Yeah, and a lot of these countries have those. I remember trying to invest in Vietnam, just buy stocks, and you have to, as you said, set up a brokerage account in those countries. Sometimes you can do it virtually, like online, but it's still that added complexity compared to other markets.
It's quite difficult to open an account in Vietnam still. Other markets are easier, but there are custodians that can execute orders for you in these markets.
Okay, so if I throw out a few countries, and then maybe you can give your opinions on them. So a few that I think look quite interesting: Indonesia, Mexico, and then maybe just Argentina, just because, as you said, it's sort of lots of volatility there. What do you think of those markets in particular?
Yes, I think Argentina is attractive. The market has gone up already quite a bit, but I think it can go higher. Indonesia, 100% agree. The fundamentals are equally compelling as India, but the market valuations are much lower. So I have investments in Indonesia, and I think the potential is good. I also have in Malaysia. The Malaysian market has done relatively well in the last 3-4 months. And Mexico, I don't have much in Mexico, but I have some bonds of Mexican companies, but dollar bonds. But and the market has done well. The currency has done well. I know some people in America, they're very bearish about Mexico. But that view I do not share. I think the country is, the central bank of Mexico is a very responsible central bank. And I think the country has a great potential.
Okay, great point. So, Marc, thanks again for your time today. I really appreciate it. My last question is, what is one message you'd like people to take away from our conversation?
Well, that's a very good question. The main argument I want to make is you understand, the central banks and the public, they think of inflation as an increase in the price of your groceries. That, I think, is a symptom. Another symptom of inflation is an increase in the value of your property, an increase in the valuation of your stock portfolio, and so forth and so on. So once we have this in mind, that price increases of assets and of consumer goods and services are all symptoms of inflation, then we measure inflation as an increase in the liquidity of a country, like the money supply or the monetary base, and there are different measures how to measure the size of the money pot. But anyway, it would seem to me that the wave of asset inflation we had 1980, 81 to approximately 2020, that this golden age of asset prices going up is over. Now, from here on, investors should contain their expectations. And in some cases, they have to maybe live with the fact that in 10, 20 years' time, their portfolios in real terms, inflation adjusted, will be down. If you bought stocks in America in 1964 or 66, by 1982, inflation adjusted, you were down. And I believe inflation adjusted, a lot of assets will go down. Now, in life, if you have 100, and in 10 years' time, you wake up and have only 70, as long as all the other people are down to 50, you have increased your relative wealth. On the other hand, if you have 100 and you go to 150, you may feel good, but if everybody else has 200, it's in real terms not desirable. So I would not worry too much about losing money, as long as you lose less than other people, because then your purchasing power goes up. And so I try to communicate to investors the returns going forward on assets will be disappointing. Now, I mentioned these special situations before, because even if the overall returns are disappointing, you can still find here and there an asset that goes up a lot. This year, sugar has performed very well. Other commodities haven't done well. Gold has done okay, nothing special. But in my view, precious metals in physical form are still attractive. And I would use the present weakness, especially if it extends a bit more, as an entry point.
Okay, makes sense.
Okay.
So I guess what we're taking away from this is not the death, but the underperformance of maybe the passive investor. And then you're going to have to be more active in looking for these opportunities, which we've talked about in these.
Yes, I think so. And diversify, so you diminish your risks.
Perfect. So Marc, thanks again. So if anyone wanted to find, if they liked our conversation, which I'm sure they did, where would they be able to find what you do?
Well, I have this website, Gloom, Boom, Doom. It's also the name of my report, Gloom, Boom, and Doom Report. And on this website, Gloom, Boom, Doom, all in one word.com, they can see roughly what information we can provide.
Perfect. I'll put that all in the description. So thanks again for your time.
Yes, very kind of you, Anthony.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.